Hello, everyone. If you're following me today, welcome to tonight's live. My name is Lunta Di La Paulo. I am a CPA and an M&A advisor. I am excited to be here with you tonight because I'm going to be sharing with you three exit mistakes that I see very often business owners seeking to exit make that cost them a fortune. And by the way, I wrote an ebook that we are providing and sharing with business owners for a limited time only for free. If you want it at the end of this webinar or live, please reach out to us and we're going to be more than happy to share this ebook with you. In fact, this ebook has 7 exit mistakes, but tonight we're going to be sharing about only the 3 exit mistakes that we are seeing business owner making the most. Okay. The ebook, in fact, will be sharing a lot more detail than we're actually able to share with you here. So I'm going to be going through this ebook document, and we're gonna be using it as the key presentation tonight. So if you have any question, if you're following me from Instagram here on my right side or through other platforms like Facebook or Instagram or on YouTube, please follow us so that you can receive a notification every time we post anything new or we release a new content. Generally, we are creating content that is educational, that is designed to make you a better business owner. Okay, so as I said, tonight we're going to be talking about 3 exit mistakes that we see business owners making, and these are deadly mistakes. These are the type of mistakes that cost them significant amount of money at their exit. So the 3 exit mistake that I'm gonna be addressing, and we're gonna be going through this order, are number 1, lack of preparation, number 2, inadequate financial reports, and number 3, emotional attachment. Okay, so we're gonna be looking and exploring these 3 mistakes. So let's kick things off with mistake number 1. Mistake number 1 is very common. Many people, from my experience, I have sat across the table to many business owners, a few hundreds of them in my short professional journey. But one thing that I've seen in common, many business owners seeking to exit, making, right, is the lack of preparation. Most business owners actually do not design their businesses for a transition or to be run by somebody else. So just to start things off, right? That's one of the mistakes that we are seeing very often people making, right? Business owners, generally build their businesses to get a livelihood from this business, to get money from this business, to pay for their living expense, hopefully and ideally, to give them a decent lifestyle and the ability to pursue their dreams. But very few business owners actually deliberately, right, build their business with the sole purpose of, look, one day I'm gonna sell this company and get money from the sale of this business, right? Many business owner, get to that place where when, either they have a financial crisis in the family, a family major sickness, or they need to move to another state where, their children's live, or they are in a place in their life where they just feel burned out, and they feel like they need a transition or they need something else, right? At that moment, when they are going looking for a business broker or an investment banker or an M&A advisor, right? It's a little bit too late, because what most business brokers and M&A advisors do is just to package your company and try to sell it to a potential, buyer. Right. That's not really the best way of doing things, because the moment, your business is brought to the market, it's a little bit too late, because what the M&A advisor or the business broker or the investment banker is not telling you is, very often in my profession, what I don't see them telling business owners often is that, this journey is gonna be so tough because of your business, right? Your business is not ready to be sold, and because of that, we might be in the market actually for a much longer than we would have than other businesses, would stay. Typically, a business sale will take, 12 to 18 months, sometimes a little bit longer, but when you don't have a business that is, that has sound financials, sound operating systems, a management team that doesn't depend exclusively on the seller, that kind of business, my friend, will stay in the market for a much longer period you know than actually, the regular type of business, because, the psychology of a business buyer is different, and many business owners actually do not know what business buyers are looking for. If they knew, the math is simple, because you can just reverse engineer what a potential buyer is looking for and build your business to deliver exactly that, right? That's the way you get, your exit goals, right? So lack of preparation is really the biggest killer here. A lot of business owners are not prepared for sale, are not prepared for exit. Their businesses is not prepared for sale, is not prepared for exit, right? And all these kind of problems or situation makes it a little bit, if not contribute to most of the challenge to actually getting the business sold, right? So here's how you know your business is not prepared, right? Here's what you need to kind of start looking into your business as you think about, selling. Can your business operate without you for, at least 4 weeks, right? Can you go for holiday and plug off completely, where you don't have to be, responding to emails or employees' requests or giving instructions about what needs to get done, right? That's number one. Number two, can you realistically agree that your business has all the processes and systems, or at least the key functions for each operation codified? They are written, that if you would hand it to somebody else, they would have minimal interruption to execute their functions or responsibilities, right? That's another measurement we track. The other element that we need to pay attention to when we are examining whether or not the business is ready for sale is the fact that the company itself has a clear information and reporting system, right? Do you have good financial that if you provide it to somebody else to examine your business, they would have a fair understanding of your financial performance, right? What sometimes we come across is business owners who don't have a profit and loss statement, a balance sheet, much less a cash flow statement. If you are in that place, that's not a good way of running business, right? Especially if you are over $1 million in revenue, that's not the way for you to run a business, right? I've seen business owners running multi-million-dollar business, and the only thing that is approximately accurate, right? I will say approximately, is their tax returns, right? Because what they do is they provide their tax preparer the bank statement, and from there, the tax preparer come up with a P&L and files the tax returns based on that P&L. That's not good governance. That's not good financial reporting. That's not, the way that when a buyer is looking at a business like that, that's a very high risk, right? There needs to be a good financial reporting system, a good bookkeeping, right? You need to be able to show to a prospective buyer how information system, how the financial information that you're displaying on your financial reports, how they come to be, from the transactions to the end of it, right? The financial report. So very important for you as a business owner to keep in mind and to pay attention to, okay? So that actually flows to mistake number 2, which is inadequate financial records, right? This is a big deal because even if a business buyer is gonna trust you, right? We go with what Ronald Reagan said, right? Trust but verify. The way that we can, reinforce the idea of trusting the information that you, the business seller, is providing, or a prospective seller is providing, is the fact that you have the support and source document that shows that when you say you have $1 million in revenue, right, you have $1 million in the bank account reflecting the income, and the fact that this income is not money coming from you personally moving cash from different account, but they are actually real client who exist, have contract with your company, and you have provided them the service, and therefore those are the payment that reflect that economic reality, right? So financial record is very important. A lot of business owners think whatever their bookkeeper is giving them, that's the true reality of the business, and that's what really matters the most. That's not the case when it comes to due diligence. If you're making this mistake, this can drastically reduce the value of your company, right? A company that could have been sold at 3 to 5 multiple can drastically fall down to 2 times multiple, because nobody can actually determine the true value of the company, because people are not able to rely on your financials, right? And I have seen, business owners with tax returns that were prepared incorrectly by their tax professionals, and even tax forms are not necessarily in evidence that whatever the business seller is saying is actually accurate, because there is a ton of people who make mistake, whether it's with the income or with the expenses, right? You'd say that's kind of a foolish mistake. Who would overstate their income? But yes, it does happen, right? Recently we had a client that their accountant included the PPP loan as income for them, right? What can we do about that? Sure, we can amend the tax return, but that's just to give you an example that mistakes do happen. And it's not a good idea to just take on the face value of the information that the seller is providing, right? And as you are navigating this process, as you start thinking about, exiting, and by the way, if you're thinking the time for exit is when you are 60 years old, that may not be the case. Each case is unique, and it has to be looked on its own merits. So as a business owner, typically I say this: if you are over 50 years of age, you really need to start thinking about your exit. What's gonna be coming next for you, right? Are you gonna transfer the company to your children, to your grandchildren? Are you going to sell the firm? Are you gonna pass it to your spouse, to a family member? Whatever that is, right? You need to start having a clear plan in mind. And the way to do that is to work with a good professional who can help you develop a good succession plan, right? So in our firm, yes, it's a new service, but we have experience working with other clients. We just have formalized it and codified it to make it an offering to potential business owners. Okay. So as I was saying, as a business owner, right, it's a really good idea to start looking into your financial records, right? Your tax returns, your financial statements, right? And business buyers, as you know, they will be asking you for the last 3 years of financial reports. Sometimes these business buyers may ask you for the last 5 years, depending on your industry. It can be a little bit longer. So you really want to make sure you have, at least 5 years of financial records and tax returns, right? But here's the but. You also need to have the source document, right? The documentation that supports whatever the financial statements or tax returns is saying, right? Things like bank statements, right? Monthly profit and loss statements. If you have budgets, is even better. If you write a great deal of checks, you need to have that. Your payroll reports, your W-2s, your 940s, 941s, right? So these are the payroll, the different types of payroll reports, right? Your your aging accounts receivable, aging accounts payable, right? You need to start building your repertoire of financial records, right? If if it's typical or standard in your industry for client to sign engagement letters or contract, you need to start organizing the contract for each client in your firm, so that when the due diligence time comes, when you start actually actively selling the company, you can show to potential buyers, all the evidence that support your company, right? Um, and it's also a good idea to start documenting through workflows how your company operates, right? Things like, how do you generate leads? How do you service client? How do you recruit, hire and train people? How you offboard people? How you offboard clients, right? What's the process for seeking, loans, you know, things like that. So, what's your process for screening vendors? So as you document all these elements, right, you are showing that you are a serious business seller, okay? That you are serious and you run a serious business, that if people have an interest, they will actually find a valuable asset in your business, okay? In your business. So that's super important for us to actually get a sense of. The number three mistake, as I said, is emotional attachment, right? This is where sometimes a lot of deals die, unfortunately, right? Because the seller or the prospective seller is highly emotionally attached to the business. And it's understandable, because you have probably spent most of your time, most of your life building the business, then even with your family or your own biological children or adopted children. So it makes sense. You have a deep emotional involvement with your business. But here's what we cannot do as business sellers, right? As business owners exploring or considering to sell the company, being heavily emotionally involved to the point where we don't see anybody else as being able to transition to the leadership of the company besides ourselves, right? That could be an ego problem. Maybe you need to see a psychologist. Maybe I'm not the right person you need to talk to, right? But it's a situation that we run through, more often than not, because sometimes a business owner who was excited to sell the company suddenly start getting cold feet and kills the deal, right? Everybody's time is wasted. Everybody's monies and resources are wasted, right? So you really need to do a soul search to think about why you want to sell the business, what you're looking for with the sale of the business, and how the sale of the business will impact and affect your life and the life of the people in your life, right? If you have, children who are part of the business, or a spouse who are, or even not part of the business, excuse me, you need to have conversations with them so that everybody understand is, excuse me, let me get some tea here. So that everybody is on the same page regarding your aspiration for the exit, right? Maybe your exit doesn't require the sale of the company. Maybe it does. Maybe your exit is just a way for you to roll back some of the hours in the business and promote from within the company, or bring an outside manager, or some other strategy, right? But all these things need to be considered carefully with the people you love, with your advisor, to make sure that you are not going in a direction that will have negative impact to not only you, but the people that matters the most in your life. So I'm gonna pause here, right? I've been trying to do these lives to be very, very short, so that, you can reflect on the information that we're giving you. And hopefully, if there is anything we can do to help, we're available to help you, to assist you, and we want to walk by your side. You can go either to our website. I'm gonna leave it below here in the comment, but please reach out if you have any question, if you need help. I'll be more than happy to assist you, to support you in your journey. God bless you. Have a great rest of your day, and I'll see you next Thursday.